Thank you for joining us for our second edition of ICM's Mic'd Up. I'm Pete Seyler, a member of the business development team here at ICM, and I'm joined once again by Mike Paciotti, ICM's Chief Investment Officer. Mike, thanks for joining us again.
Glad to do it.
So let's jump in, and recently we've seen a lot of volatility, really since the beginning of this year, much of which has been fueled by the uncertainty around the Russia-Ukraine situation, rising inflation, and the Fed's attempts to get it under control. In your opinion, how do you see the near term playing out for the U.S. markets?
So there are actually a few issues at work here. First, we've been living in an elevated valuation environment for a while now that has really culminated in some extreme valuations, especially for growth stocks. So as I've talked about in several of my quarterly letters and in various blog social media posts, growth stocks among the equity styles are the higher equity duration or more interest rate sensitive style of the US market. So much like zero coupon bonds, growth stocks don't return capital via dividends as quickly as value or coupon paying bonds. So this creates that interest rate sensitivity. Now, as rates declined, much like a high duration bond, growth stocks benefited from the discount rate declining more so than the broader market or value, but all of them benefited to some degree. So now let me be clear on something. All the changes of the discount rate do is either pull return forward or push it back in time. It doesn't create or destroy return. It just changes the timing of when you receive it, sort of like borrowing from Peter to pay Paul. So the consequence of declining rates and pulling return forward was that it left the market at the end of 2021 at one of the most expensive levels that we've seen in the last 140 years, really priced to provide very low returns for the next decade for US stocks, say less than 1% per year. So that's really issue number one. We have to deal with and are dealing with the massive valuation overhang that we have in US markets. Now, issue number two that you mentioned in your opening remarks is inflation, and is really the pin that's popping that valuation bubble. So as rates go up, specifically long rates, valuations on stocks decline, more for growth, less for value through the same mechanism that we just discussed a minute ago. So as a result, you have in round numbers, the S&P down 20%, the NASDAQ down 30%, and value stocks down 12%. So while most will point to supplies being the problem, the Fed can't control that, but they can control demand. They can make us all buy and spend less by making debt more expensive or by creating a business climate that forces hiring to slow or even forces layoffs. So this reduces the dollars that chase around a fixed amount of goods that are available. So rates are one transmission mechanism, but so are capital markets, stocks and bonds. By stocks going down in value, people feel less wealthy, spend less money, and this cools inflation, a negative wealth effect. So ultimately, where does this leave us? We have a Fed that's determined to cool inflation, and until supplies improve, they're going to press down on demand through rates, equity valuations, the labor market, and even the economy. So the near term, in our opinion, is really not that rosy for the US, at least until the supply chain can resolve itself. We really expect more of the same, with pressures on valuations coming from either rising rates or economic concerns. I think the Fed really has very little wiggle room to let things get too rosy. They really need a sanguine consumer and investor to fight inflation.
Great, Mike. And in your comments, you mentioned valuation. So from a valuation standpoint, international markets have really been more attractive for quite some time. With inflation and recessionary fears spreading globally, what are your expectations for international developed and emerging markets through the end of the year?
Yeah, so that's a good question. Over the last decade, US stocks have given you 14% return, while EFA value has given you 6%, and emerging markets value has given you 3%, a big gap in performance. So in that time, the US has moved from a Shiller CAPE ratio of 18 times earnings to a CAPE of 30 times, while EFA value has moved from 9 times to 12 times. Similarly, emerging markets value has actually gotten cheaper, moving from 13 to 9. So if we do the math, when comparing the US to international value, 5% of that performance gap comes from the valuation of the US and its currency simply becoming more expensive relative to foreign value, not from fundamentals, just investors paying more, really the bubble kind of inflating. So when we compare to emerging markets value, the gap was 11%, with all of that gap explained by the US valuation or the valuation of the dollar getting more expensive. Again, not fundamentals, something that certainly has a finite lifespan for all assets. Now, if we study history, we know that these things tend to move in waves, with good decades followed by bad and vice versa. So looking forward, we have a beginning dividend yield of over 4% for both foreign and emerging markets value compared to 1.5% for the US, and couple that with valuations at 60 to 70% discounts compared to the US, along with currencies that are very weak versus the dollar. And I think you have all of the ingredients to see the exact opposite of the last decade and get a decade of dominance from non-US stocks. Now, in the near term, I think developed Europe is behind the US in its rate policy, but probably needs to do less. So this should be favorable not only for valuations, but also for allowing those currencies to really get stronger versus the dollar. In the emerging world, I think, though, it's all about relaxing restrictions and keeping COVID under control. So if they're able to do that, we could see a run in emerging markets that resembles that period in the early part of the millennium where the emerging world outperformed domestic stocks by several 100%. So finally, while highly unpredictable in the short term, over any sufficiently long horizon, say 5 or 10 years, you are pretty likely to see a resolution to the war in Ukraine. So any resolution to that conflict would have a disproportionately positive impact on emerging markets and international equities.
Great, Mike. Really good stuff today. I really appreciate you taking the time and sharing some of this information with our advisors out there. And lastly, speaking of advisors, we've spoken with a number of folks out there who are working with their clients to navigate through these really difficult market environments that we're seeing. If there was a single thought, one thought that you could share with them, what would it be?
So we get a lot of questions in light of our views about going to cash. So everybody knows it's a bad idea, but the topic still comes up. So I'm going to give you 2 answers, one quantitative and a second a bit more qualitative. The reason that you don't do it in both cases is because it doesn't work, right? So take any sufficiently long holding period and your odds of winning in cash decline substantially. Since 1926, there have been only 9% of all rolling 10-year periods where cash outperformed bonds. The average margin of victory if cash actually won was only 4%, or 4 basis points, I'm sorry. When it lost by 200 basis points per year for the decade. With stocks, cash only outperformed in 6% of environments with an average victory margin of only 13 basis points. But when cash lost to stocks, it lost by nearly 8 full percentage points a year. So the frequency of winning in cash and the magnitude is really not in your favor the longer that you sit there. So even as negative as we are in the US at the moment, our 10-year return estimate is still significantly higher for US stocks than cash. And the good news, if there is any good news to the declines that we've seen recently, is that we now have the US providing about a 4 to 5% return for the next decade, much better than that 1 to 2% that we saw just a few months ago. Now, the second way I'll respond is a bit more surface level and near-term focused. So thus far this year, neither stocks nor bonds have really been a whole lot of fun, with the bonds declining by 9 to 10 and stocks declining by between 10 and 30, depending on what you own. So at least at this point, the idea of hiding from a bond market route in stocks has kind of gone away. But what about cash? The way I've responded to this when clients ask is that this year is nothing more than a series of bad options. You've lost 9 or 10 in bonds, 10 to 30 in stocks, or 8 to 9% of your purchasing power to inflation if you sit in cash. Take your pick. It's really a series of bad options that have been presented to clients this year. At least in longer term, in stocks and bonds, you're statistically likely to recover with the benefit of time.
Great. Mike, thanks again for joining us for this, our second installment of ICM's Mic'd Up. And just as a reminder to everyone, you can contact the ICM team here via email at info@icm-invest.com or by phone at 888-426-4689. Thank you.